Investors, I know you want another chance at an ETF that pays dividends, but also offers excellent opportunities at capital appreciation. Well, say no more, you have come to the right place, as today we will review another dividend ETF in WisdomTree's Total Dividend ETF. The ticker symbol is DTD, not to be confused with the pesticide DDT. We're trying to actually build up dividend trees over here, not try to tear them down forever. This video was made directly because of a viewer named Caleb who brought it to my attention. Just a reminder that if you ever have a video request, let me know in the comments below, because I might just make a video about it. Also be sure not to bow down to censorship and hit that like button. Trust me, it won't hurt my feelings. Make sure you're subscribed while we're at it, because I make videos like this all the time. In fact, I even have my own playlist on different income ETFs as well as dividend ETFs. Now let's get a quick overview of what Total Dividend does here. So DTD tracks a fundamentally weighted index of US companies based on the dollar amount of dividends that they pay. This is different than just buying companies with the highest dividend yield percentages. This index is called the WisdomTree US Dividend Index. They seek out big dividend payers and conduct weighting based on how much dividends can be expected in the next 12 months. Again, this is the total dollar amount of the dividends. The fund is rebalanced every December based on the amount of dividends a company is expected to pay, and making sure that they also meet other criteria such as liquidity and market cap requirements of WisdomTree. More information about their requirements can be found under the WisdomTree rules-based methodology, but their metrics feature all of the important info such as market cap of at least 100 million, average volume needs to be at least $100,000 daily. They also have a quality and momentum factor score, and that's given based on trends on recent returns on equity, returns on assets, and return on cash flows. It also has a percentage cap on how big a sector can be, how big an individual stock can be as well. Again, these are all things that an intelligent investor would look at when making their own portfolio, but that is super time consuming. With WisdomTree's ETF, we can have a professional manage it all for us for a pretty small fee of just 28 basis points. Some more good news is that this fund actually tracks REITs. So many other dividend ETFs just completely exclude them. It also includes the energy sector as well. So glad to see that we can get exposure to two of the best paying dividend sectors in this ETF. Unfortunately, they do not offer any downside protection, so if the market crashes, you have to go along for the ride. Before we take a look at the top holdings of DDT, let's actually take a look at the top 20 companies that pay out the most in dividends to their shareholders. Again, this isn't the companies that have the highest dividend yields, but the companies that pay the most in total dollar value of dividends. We have very established blue chip companies like Microsoft, AT&T, ExxonMobil, Apple, JP Morgan Chase, AbbVie, Pfizer, Home Depot, Coca-Cola. They all lead the charge. And then when we look at the top holdings of DDT, we see that every single company in the top 10 was included on that top 20 list of biggest dividend payers. We have Microsoft, Apple, Johnson & Johnson, Chase, Verizon. These are all very solid companies that have competitive moats and will likely increase their dividends over time. When we look at sector breakdown, we have tech, financials, and consumer staples making up the largest slices of this ETF. In fact, those three sectors make up more than 50% of the ETF. But we also get great exposure to all the other sectors like healthcare, utilities, energy, as DDT will take the largest dollar amount dividend payers from each of those sectors. Let's show a comparison tracker to another income ETF, such as QYLD, as well as other dividend ETFs like SCHD and DGROW. Again, the comparison here is that the people who own one of these ETFs may also own another. It's more for informational purposes, not to say that these ETFs are all super similar. So QYLD has been around for nearly 8 years, and they have ballooned to over $5 billion in assets under management, and they have a very impressive 12-month dividend yield of over 12%. That's basically getting 1% back on your investment every single month, which is absolutely insane. Their expense ratio is 60 basis points, which is $60 for every $10,000 invested. That's not exactly cheap, but let me tell you that writing covered calls and doing options trading is not always the easiest, and it's also very time and capital consuming. Dividend ETFs like SCHD and DGROW from Charles Schwab and BlackRock have been around for 7 to 10 years. They also pay out strong dividends, but they offer just around a 2% yield. But as we saw in the videos that I made about these dividend ETFs, the yield on cost can get very ridiculous over time because the ETFs specialize in finding companies that historically give dividend raises over time. They pay out dividends every quarter compared to QYLD, which pays out monthly, and QYLD owns the NASDAQ 100 compared to the 100 to 400 holdings that SCHD and DGROW hold. Now, when we take a look at DDT stats for the first time, we can see that they have been around since 2006. That easily beats out any other ETF that we have looked at in the past. It's great to have a proven track record of 15 years of consistent dividend payments. Around 2012, that's when they went from paying dividends every quarter to now, on a monthly basis, they will distribute dividends. Something that is usually only seen when ETFs do options trading, but there is no options trading done with DDT. They hold about 660 screened dividend companies. Now, I'm not going to say those are all blue chip because there probably isn't over 600 blue chip companies, so I'd say that DDT puts extra emphasis on companies that pay the largest dollar amount in dividends, and then slowly starts to weigh them less with rebalancing done every December to see if their criteria are still met as they track the US Wisdom Tree Dividend Index. This is the first ever ETF that I've reviewed from Wisdom Tree, and they charge 28 basis points for their services. So a little bit more expensive than the other dividend ETFs, but still cheaper than QYLD and most of the other income ETFs. Although their dividend yield is just about 2% today, I'll show you why that's not necessarily a bad thing. And that would be because of this ETF's fantastic dividend growth over the past 15 years. Only once had they not increased dividends from the year prior, and that was during the 2008 financial crisis. In 2010, they paid just $1.34 in dividends, and they traded at just $44.90. Now let's say that we bought shares of DDT back then and simply just bought and hold for all those years and collected dividends. DDT now trades for around $124 at the time of this recording, and they pay around $2.60 now in dividends per share, which would give us just under a 6% dividend yield on cost, and the distribution should be taxed as a qualified dividend since there is no options trading. Some of the distribution may be non-qualified since they do own REITs. Lastly, let's take a look at the performance over the last 10 years versus the S&P 500. They have actually been lagging behind at 13.4% annual return versus the S&P 500's 16.63% annual return. Of course, just because it underperformed in the past decade, that doesn't mean that they necessarily will underperform again for the next 10 years. I just wanted to bring this up as it's important to know. I really do like the big dividend payers allocation strategy that DTT follows, because from a competition standpoint, ideally companies that pay the largest dollar amount in dividends tend to be companies with big moats, and they should be able to continue to dominate in the future. Let me know what you think of DDT in the comments below, and be sure to hurt my feelings by liking the video. It really helps out with the algorithm, and if you have any video requests, let me know in the comments below, and I will BS CC you later.